What are bonds and how do they work? A bond is a loan to a company or government. It fetches investors a fixed rate of return. Simply, a bond is a loan from an investor to a borrower, such as a company or government. The borrower utilizes the money to fund its operations, and the investor receives interest on the investment. The market value of a bond can change over a period of time. A bond is a fixed income instrument, which is one of the three primary asset classes or groups of similar investments often used in investing. Well, the definition of bond is a bond is a loan to a company or government that pays investors a fixed rate of return over a specific time period. Bonds are a key constituent in a balanced portfolio. Average returns. Long-term government bonds historically earn around 5% in average annual returns versus the 10% historical average annual return of stocks. Risk bearing. A bond's risk is based mainly on the issuer's credit worthiness and reputation. Interest rates also influence a bond's value. Advantages. The relative safety of bonds helps balance the risks associated with stock-based investments. How does a bond work? Bonds work by paying back a continuous amount to the investor, known as a coupon rate, and are thus referred to as a type of fixed income security. For example, a $5,000 bond with a 10-year maturity date and a coupon rate of 5% would pay $250 a year for a decade, after which the original $5,000 face value of the bond is paid back to the investor. Benefits of buying bonds. Bonds are comparatively safe. Bonds can create a balancing equation within an investment portfolio. If you have a majority invested in stocks, adding bonds can diversify your assets and lessen your overall risk. And while bonds do carry some risk, such as the issuer being unable to make either interest or principal payments, they are generally much less perilous than stocks. Bonds are a form of fixed income. Bonds pay interest at regular, predictable rates and periods. For retirees or other individuals who like the idea of receiving regular income, bonds can be a assured asset to own for them. Drawback of buying bonds: low interest rates. Sadly, with safety comes lower interest rates. Long-term government bonds have evidently earned about 5% in average annual returns, while the stock market has returned 10% annually on an average. Some risk is involved. Even though there is typically less risk when you invest in bonds over stocks, bonds are not risk-free. For example, there is always a chance you will have difficulty selling a bond you own. Categorically, if interest rates go up, the bond issuer may not be able to pay the investor the interest and principal they owe on time, which is called default risk. Inflation can also reduce your purchasing power over time, making the fixed income you receive from the bond less valuable as time goes on. Bonds are units of corporate debt. issued by companies and securitized as tradable assets. A bond is referred to as a fixed income instrument since bonds traditionally paid a fixed interest rate, that is coupon, to the debt holders. Variable or floating interest rates are also now quite common. Bond prices are inversely correlated with interest rates. When rates go up, bond prices fall and vice versa. Bonds have maturity dates, at which point the principal amount must be paid back in full or risk default. Features of bonds. Most bonds share some common basic characteristics, including face value is the money amount the bond will be worth at maturity. It is also the reference amount the bond user uses when calculating interest payments. For example, say an investor purchases a bond at a premium $1,090 and another investor buys the same bond later when it is trading at a discount for $980. When the bond matures, both investors will receive $1,000 face value of the bond. The coupon rate is the rate of interest the bond issuer will pay on the face value of the bond. Expressed as a percentage, for example, a 5% coupon rate means that bondholders will receive 5% multiplied by $1,000 face value, that is $50 every year. Coupon dates are the dates on which the bond issuer will make interest payments. Payments can be made in any interval, but the standard is semi-annual, that is 6-month payments. The maturity date is the date on which the bond will mature and the bond issuer will pay the bondholder the face value of the bond. The issue price is the price at which the bond issuer originally sells the bonds. Two main features of a bond: credit quality and time to maturity. These are the principal determinants of a bond's coupon rate. If the issuer has a poor credit rating, the risk of default is greater, and these bonds pay more interest. Bonds that have a very long maturity date also usually pay a higher interest rate. This higher compensation is because the bondholder is more exposed to interest rate and inflation risks for an extended period. Categories of bonds. There are 4 primary categories of bonds sold in the markets. However, you may also see foreign bonds issued by corporations and governments on some platforms. Corporate bonds are issued by companies. Companies issue bonds rather than seek bank loans for debt financing in many cases because bond markets offer more favorable terms and lower interest rates. Municipal bonds are issued by states and municipalities. Some municipal bonds offer tax-free coupon income for investors. Government bonds such as those issued by U.S. Treasury. Bonds issued by the Treasury with a year or less to maturity are called bills. Bonds issued with 1 to 10 years to maturity are called notes, and bonds issued with more than 10 years to maturity are called bonds. The entire category of bonds issued by a government bonds is often collectively referred to as treasuries. Government bonds issued by national governments may be referred to as sovereign debt. Agency bonds are those issued by government-affiliated organizations such as Fannie Mae or Freddie Mac. Elucidating further, bonds can be mainly classified into government bonds, corporate bonds, tax saving bonds, bank and financial institution bonds. And the investors can buy these bonds by opening an account with a broker. It is also advisable to check with your financial advisor before making your investment in bonds and to know which one to choose from. And yes, don't forget to subscribe to the channel for future learnings. Thank you.